So I will give a little bit of an introduction of my background. So I trained as a primary care physician. I did a program called Biodesign at Stanford, which is essentially a boot camp in entrepreneurship with a focus on healthcare technology. And then I joined a startup, ran product for them, helped them launch a couple of software as a service products, selling to hospitals and health systems. And then went on to do my MBA at Wharton School of Business in Pennsylvania. And recently moved back to the Bay Area and now lead healthcare investments at an investment fund in San Francisco called Coda Capital. So what you're seeing on here is a quote from Sun Tzu from a book called The Art of War, which is basically a Bible for military strategy, but I think it applies to other aspects of life as well. The message here is you should take the time, if you're kicking off the fundraise, take some time to delve deeper and think about yourself as well as get to know your investor. So we're going to start with knowing yourself. I think it's extremely helpful for all of us to do a SWOT analysis on ourselves before we kick off the fundraise. What are your unique strengths? Where could you use some help? What are you looking to learn or grow into? And what are you most afraid of? So personally for me, when I started a business coming out of Stanford, as a physician, I was really familiar with the concerns of the patient, the different stakeholders within the hospitals and health system. So that was certainly a strength that I brought to the table. But I had never built a financial model before. So what did I do? I found a co-founder who had. So that's recognizing your weaknesses and taking steps to overcome them is a strength. So augment, outsource, partner with other people who can help you in areas where you could use help. There will be always some unique opportunities that are available to you to grow and learn. For example, if you're a physician, you might be able to look to your colleagues to quickly test your product and give you some feedback. But you will also have some blind spots, especially if you're a first-time entrepreneur. You will be dealing with a lot of different stakeholders that you've never dealt with before, shareholders, investors, board members. The good way to overcome some of these blind spots is to have a very diverse team, encourage conflict in your discussions, and make sure you're constantly communicating with all the different stakeholders and keeping them aware of what's going on with you and with the company. Fundraising strategy. So this is some data that TechCrunch published a little while ago. This is specifically for seed rounds. On an average, to raise $1.3 million in a seed round, an entrepreneur has to reach out to 58 investors and have about 40 meetings. It takes about 12 months to close the round. An average pitch deck is about 19 slides, and an investor spends 3 minutes and 44 seconds on average on your pitch deck. When you're kicking off the fundraise, the goal in your fundraise is to get multiple term sheets in a very short window. You can do this by generating a lot of interest and competition around your business. Especially in the Valley, when any entrepreneur thinks about fundraising, the first thought that comes to mind is go to a VC. Not every business is investable by a venture capitalist. An average VC is looking for a 10x return in 3 to 5 year period. That requires that you must be tackling a huge market, growing very rapidly, and looking to exit your business, which usually means either sell it to a bigger company or take it public within the 3 to 5 year time period. Now, it's perfectly possible to build a great business which is profitable and runs for 100 years that may not be interesting to a VC, and you may have to look for alternative sources of funding to get that started. The other thing to critically think about is the stage of your business. What milestones have you achieved? Do you have customers and are generating any revenue? Do you already have profits? Are you still in the product development phase? And what is the next inflection point for your business? Would that be the launch of the product? Would that be getting your first 5 key customers or entering a new market for a new indication? Getting a good understanding of the stage of your business will help you with 2 things. Picking the right investor partner and also determining how much you need to raise in order to get to the next inflection point. In terms of how much you need to raise, I always advise entrepreneurs to have a fixed number in mind, because if you try to give a range, oh, I could raise this much and that much, it just gives the impression that you haven't given it serious thought. And start on the lower end, because if you start very high and you're not able to fill the round, a lot of investors will say, I'm only investing if you're able to fill the round. so you will not be able to close the round. If you start low and there is more interest, you can always extend it. You need to think long term. So or especially in early stages of the business, you are going to be working with these investors over a very long period of time. So you should think critically about what is your business going to need over this period. Do you need someone who has operational expertise and can help you build and grow your team? Do you need someone who has a lot of strategic connections and could help you win a couple of early customers, or potentially look at an exit strategy of getting acquired by a strategic? Cultural fit. This is extremely, extremely important, especially in early stage companies. You need to know if your investor's working style matches yours. Are they hands-on? Are they hands-off? Do they like to know everything, or do they only want to know when something goes wrong or where they can actually help? What do you like as a founder and a CEO? Do you want to be managed? Do you want to be coached or developed? Is their style very informal, more than yours? So I think the working relationship will be great if you're able to get this cultural fit assessment right when you're fundraising in early stages. A good tell for cultural fit is social media. VCs are usually very active on social media. We tweet, we blog, we speak on podcasts. That can tell you a lot about how an investor thinks and what are the points where you can connect with them, or where could there be friction. Initial outreach. So the most important thing in initial outreach is to be concise, relevant, and comprehensive. Now, I'll get into what I mean by that. But before you even reach out to an investor, you should do everything you can to learn about them. Most investors publish their investment thesis on their website. They have team bios on their website. Most of them have a portfolio on their website. Look at the website, try to get a feel for what kinds of things do they like to invest in. Who within the firm it will be the most appropriate person for you to connect with, maybe because you have some common ground, or maybe because you're looking for a specific expertise that this person brings to the table. Engage with them on social media, walk up to them in conferences and industry events, introduce yourself. Always try to offer something of value. Maybe you know someone that can be hired by one of their portfolio companies, or you recently read this research report or market report that is very relevant to their investment thesis. That just says that you have given some thought and you're very selective and thoughtful about who you want your investor partner to be. Now, when you do reach out, and if that happens to be through email, it's very important that you pack all the relevant information in your first email without sounding too verbose or long-winded. I've tried to show here an example of an email. I'll go over what this email does really well for me. So the entrepreneur establishes credibility in 2 short sentences. He says, I'm a physician and a serial entrepreneur. This is my 3rd company. I sold my last business. Now, not everyone has to be a serial entrepreneur or a physician, but whatever is your strength, whatever makes you uniquely positioned to succeed in this business can help you gain some credibility here. He goes on to explain in 1 sentence what his business is doing. I use behavioral economics to improve adherence in patients with chronic conditions. Then he outlines 3 different categories of customers and specific value that he's providing to all of those 3 categories of customers: risk-bearing providers, payers, and life insurers. He attaches his investor materials, which is a deck and a link to the data room. And then he tells me about the details of the round. He already has a lead investor who's anchoring the round. He's raising X amount of money, and this is his timeline to close. Believe it or not, this very simple, concise email saved both of us, me and the entrepreneur, hours and hours of time. When I was done going through the deck and through the data room, all I had to ask him was 5 questions before my diligence was complete. This is a rare occurrence. Most of the emails that I get are not like this. So I think you can figure out ways to be very concise, but still pack all the relevant information in as few words as possible. Now, the pitch. So your goal in the pitch is 3 things. You have to stimulate interest in your business. You have to educate them about your product and your market. And you have to foster confidence in your ability to execute. The most important thing with the pitch deck is to have several versions of it. I recommend at least 4 versions. And what you're seeing out here is a rule of 10, which is I'm going to go into why I think every company should have at least these 10 slides. You should have 2 versions of this 10-slide deck. One to present in person or over web or Skype, and the other one to send over email. Because the deck you will usually send over email will have much more text and detail than the one you will present, because you're not there in person to provide the context. You should have a third deck, which should be a 30 to 40 slide deck, which has about 3 to 5 backup slides for each one of these 10 slides. And then you should have a master version just for yourself, which includes every question that you have been asked in every pitch meeting that you have gone to, so that when that question comes up again in the next meeting, you can just quickly pull it up and you have the answer. In terms of the slides, so what you're seeing here is a graphic, again, from a study done by TechCrunch on how much time do investors spend on each slide. Now, this is done for the seed stage fundraise. I think that is the most relevant for this room. But the amount of importance and time on these slides changes as your company grows. The important thing to take away here is that there's only one slide where every investor is spending time, and that is your team slide. That is usually determining whether I take the meeting or not, especially for very early stage companies, because you don't have the numbers to show. So spend some time putting together a team slide with brief backgrounds of all of your founding team, initial team, if you're a later stage company, the C-suite. Explain the rationale or the unmet need, the problem that you're trying to solve. Market size is essentially having a view on how many people will use this product. There are 2 ways you do market sizing, bottoms up and top down. Top down is usually people go to industry reports and try to figure out how many people can use their product. The bottoms up way of saying is how much of this problem is existing in the market and how many of those people will actually end up using your product. We have something called the total addressable market, which is 2 million patients in the US have atrial fibrillation. Then serviceable market, which is I'm only planning to service mild and moderate atrial fibrillation. So that becomes your serviceable market, which would be a fraction of your total addressable market. And then something called share of market. You're not going to be the only company treating for atrial fibrillation. So I'm expecting to capture 10% of the market share in the next 3 years, and that means this much in dollar numbers. Product, if you have a demo, absolutely always do the demo. We get very excited when we see the demos, our eyes light up, we're more engaged. You will get real-time feedback from the investor and whether he's actually interested in your product. And outline the roadmap for us with some timelines. Explain your business model. Business models can be complicated, especially in healthcare. They're not always necessarily, your user may not be, your payer may not be the decision maker, so help us navigate that maze and understand how you're actually going to be making money. Competitive landscape, don't forget to include what is your unique competitive advantage over everyone else in the market. Market traction. So this is key to fostering confidence that we talked about earlier. How many users do you have on your platform? How often are they visiting your platform? Do you have any signed contracts from enterprise customers? Do you have some conversations in the pipeline? Anything that you can do to tell us to show that market is validating your product. Financials. These become more and more important as you grow as a company. When you're just starting at a seed stage, pre-seed stage, you're just an idea and you probably don't have any financials. We would still like to see what is your view of this business going forward. They should usually include actuals, if you have any, and 3 to 5 year projections. The numbers that people most often forget to include on this slide are your monthly burn and your total dollars raised so far, because that really gives us a sense of how you're running your business. Regulatory and reimbursement path. This is specifically critical, obviously, for healthcare companies, and if this applies to your product, then have a plan for sure. And if you've made any progress on that plan, if you're in conversations with FDA or CMS, let us know. Most important one, the fundraise itself. What are you asking for? Have a clear ask. Give us a specific number. This is how much you're raising. This much of it is committed. How are you planning to use this money? What milestones would you achieve using this money before your next fundraise? So I have an example of a pitch deck that I'm going to run through. The slides are pulled in from different pitch decks, but I think it might be helpful to give you guys a little bit of context. So this is essentially, we developed an anticoagulant monitoring system for monitoring warfarin levels. So it gives you a very high level sense of, this is the problem, it's a $100 to $200 million market. This is how you do market sizing. So 2 million new patients per year, this much of them is in California. 20% of them get hospitalized within 6 months for misdosing. This is how much it costs, and hence we get to the number 100 to 200 million. The important thing here is to walk us through your math. Don't just throw a $1 billion market size number on there. Product, key features of your product, and you see the one feature that is highlighted in red is the key problem that your product is solving. It's reducing the testing time from 1.5 hours to 3 minutes. Regulatory strategy, again, if you have made any progress on any of this, if your application has been filed, if you're in conversations with FDA, let us know. What reimbursement codes is your product getting paid under? What milestones are you hoping to achieve, and what is your plan for the fundraise? It doesn't have to be as comprehensive and colorful as this one, but give us an idea of these are the milestones that we expect to achieve with each round of financing. Your business model, how are you going to make money, revenue model, and cost structure. This is a much more detailed financial model than you probably need, but you should have something like this in a backup in case the investors want to dig into the numbers. The most important thing on financial model is if you didn't make it yourself, you must circle back with whoever made it and understand every number on that spreadsheet before you put it in your slide deck. This is a bonus slide. Most entrepreneurs will not have this slide, but this sets you apart from good to great because you've thought about what are the risks to your business, and you've thought about how you're going to mitigate them. Diligence. So once an investor is interested in your company and your business, they will move to something called due diligence. It will serve you well to prepare a very comprehensive diligence folder beforehand, including your team bios, some details about your customer, basically everything that you had on the deck in a much more detailed form. The other important thing to remember in diligence is that it is a two-way street. When they're doing diligence on you, you're also doing diligence on them. Take this time to connect with them at a personal level. Ask what matters most to them and why. This will come handy in your term sheet negotiations later. Also, you have every right to ask them about their process. How long does it take? What are the steps? You should ask them for introductions to founders in their portfolio, especially the ones that are not doing so well. You should ask them for references as board members, and ask how they plan to specifically add value to your business. At the same time, before you even kickstart the diligence process, make sure you close out any skeletons. If there was an early co-founder who left the business, or you have a pending lawsuit, make sure you take care of that. If there are things that couldn't be wrapped, be honest about any challenges, because nothing puts your credibility more into question than us finding out something that you were not upfront with. Respond promptly and accurately. This is, I forgot to say this in the pitch deck, but if you're asked to send a pitch deck, send it the same day. If you're out fundraising, you should have a pitch deck ready that you can send at a 5-minute notice. Observe and learn during the diligence process. It's amazing how much you can learn about a person by what he chooses to focus on. If during the entire diligence they have been harping about your revenue numbers or about your customer satisfaction, that is going to be the theme of your partnership going forward with them. So use this time to discover what actually matters to them. Again, going back to, you must know the basics of every aspect of your business, including the numbers. At any point in time, at a very high level, you should be able to spend 2 minutes and explain the regulatory strategy, the reimbursement strategy. Even if you hired a regulatory consultant to make it for you, make sure that you circle back and wrap your head around it before you go out on the ground fundraising. Be honest to us about challenges. All investors know that startups are going to run into challenges. The more they anticipate them, the more prepared we are and you are, and we can help you overcome them. Congratulations. So you've gone through your 58 meetings and you have done the diligence process and now you have a term sheet. The important thing to remember here is, like some other negotiations in life, this is not a transactional negotiation. This is a situation where you absolutely have to come out with a win-win answer. If one party comes out feeling they lost and the other person won, they're going to hold that against you for the entire period that you're working together. Take ownership of this process. Remember, your lawyer is a representation of you. Take the time to pick a good lawyer. Check their references. But even after you have done that, don't outsource everything to the lawyer and sit back. Check in with the VC directly every now and then. Keep tabs. If you have a syndicate coming together and there's a lead investor negotiating on behalf of the syndicate, even then, make sure you communicate individually with every investor. Know what you want in this negotiation, and know what your walkaway point is on each individual term and overall before you step into the negotiation room. Terms will follow you in later rounds. So the way this works is, if you had a certain term sheet agreed upon in Series A, when your Series B investors come along, they will say, I want the same terms plus X, Y, and Z. So terms of your early rounds will get carried forward, and hence be careful what you're committing towards. Focus on the big picture. Don't negotiate point by point. Make sure you're looking at the document holistically and negotiating overall. Try to get some early wins. Pick a few anchor terms and nail them first. This establishes goodwill and gives you some forward momentum and will be helpful when you're engaging on more contentious terms later on. As far as possible, my advice to first-time entrepreneurs is to avoid making the first offer. Let the investor make the first offer, because you don't want to cap the upside. Board. It's very important for the early stage companies to regulate the size of the board. A board will usually consist of a CEO or a founder and one investor representing each series of the financing round, and an independent board member. For early stage companies, I don't think a board should be more than 3 to 5 members, unless you have a specific reason that you want a strategic or an independent board member to participate, because they will be particularly helpful. When picking your board members, prioritize your relationship and alignment of working style over everything else. If they have been on 10 public boards and they have this huge brand associated with it, they might not have time to serve on your board. So think about who will be actually engaged, helpful, watching out for you. That's about it. Questions?
Some entrepreneurs to not send a deck at all in the first meeting or before a meeting, just because the investor will read through it, come to their own conclusion before you even met them. What is your opinion on that?
So my opinion is it depends. It depends on...
Can you repeat that question?
Yeah, absolutely. The question was that some entrepreneurs prefer not to send the deck at all before they meet the investor, and what is my view on that approach? I think it depends on how you got introduced to the investor and what is your level of credibility. If you are a fourth-time founder and know everyone in the investing world and someone made a mutual introduction, they'll take a meeting without even having seen the deck, probably. But if you're cold emailing me with a 2-liner, which I get every day, I'm starting a blockchain in a healthcare company that is going to revolutionize healthcare, I'm not going to respond because I get so many of those emails every day, right? So it really depends on what is it that would lead them to spend their time, an hour of their time with you in that meeting. How do you get there?
You use the term seed stage, and I've noticed with VCs and stuff, seed stage to a VC can mean $1 million in revenue, and to an entrepreneur it means 0 revenue. What's your definition, and what do you think
I mean, so there is no hard definition, right? That's why everyone interprets it their own way. Personally, I think anything that is pre-product is definitely seed. There's debate on if you haven't achieved something called the product market fit yet, a lot of people would consider that essentially seed. What that means is that you have gone to market and tested out the demand for your product, and people actually want it and are willing to pay for it. If that hasn't been proven yet, I consider that seed. But anything before that, when you're even like in your product development phase, is definitely seed.
How have the round sizes changed for seed stage?
Yeah, they have ballooned. Yeah, people are raising insane amounts of money in seed, and now there's something called pre-seed, and people are raising that. So the numbers, and by the way, that phenomenon is not just for seed. Even for Series A's and B's, we're seeing the amount of capital being raised much larger than it used to be 5 or 10 years ago, for sure.
Where do you see the most healthcare spend in the next couple of years, and what solutions have you seen for this?
In terms of when you say the most healthcare spend, you mean like the problem space?
Yeah.
I think chronic conditions, chronic disease management is definitely one. That is a big issue. Mental health is another one, of course. And then the whole aging in place market is also a huge market, with us growing and aging as a country, and we have more adults over 60 than we have ever had before. And quite frankly, we're not equipped to handle that population because there are only so many transitional care facilities. So how do you help these seniors age in place in their own home environment in a safe, secure manner? I think that is going to be a big one.
Using your experience, do you have any comments on current average valuation for medical device technology companies?
So the question is, do I have any comments on the current average valuation for medical device companies? There is no such thing as an average valuation. I think it depends on the stage of your company. It depends, honestly, on the team, the more experienced teams, because essentially we're taking a risk at a very early stage of the business. The more we can de-risk it, and that's why valuations are higher in later rounds, because the business has been de-risked. So if it's a fourth-time founder who has executed successfully 3 times before, that is a de-risking mechanism, and they might be able to command a higher valuation. So I really don't think there is an average range for valuations. I would say one of the pieces that I didn't cover is when you're negotiating the terms, address valuation last. When you're a very early stage company, don't get too hung up on valuation.
What are the strategies that you would suggest when you are pre-product for approaching investors? I mean, in terms of, I don't mean the email approach, I mean the strategizing of the individual investors or the investment groups to go after.
Sorry, can you restate the question one more time? Are you saying?
It's more the bigger arching picture of, you have you're in pre-production, you're in development, and there's the world of investment groups and individual investors out there who might be interested in your product.
Mm-hmm.
What is your overall kind of a general approach that you might suggest to how you start to initiate communications?
With angel investors, essentially.
Correct.
So I think what works with the angel investors is obviously mutual connections, and warm introductions definitely help. There are plenty of people who are passionate about something very particular because they care about that disease condition because a family member had that, or they're just really passionate about a particular product. I think you're well positioned to figure out those individuals and target them. The other thing that you can do is also there's a lot of non-dilutive funding available depending on the product that you're working on, especially in healthcare. Can you just write a grant? Can you do an SBIR? Can you approach a philanthropic foundation like the Gates Foundation? Maybe they will give you some money to get to the product. So there are multiple approaches to take there. It's a less organized fundraising process than it is with institutional investors, of course. So it's a lot more knocking on doors, essentially.
When you're assessing a seed stage company, what strategies and tools do you use to come to evaluation?
So at seed stage, it's the market and the team. So do I believe in that problem space? Do I believe that now is the right time to go after this market? Are the regulatory winds in favor? Do I think that this product will get reimbursed? What's my view on that market? And usually investors will have a view, VCs will have a view. I'm never going to invest in this space. I have been looking for an investment in this space for the last 3 years, but haven't really found one. And then it's the team, the founders. Seed stage, the most important thing that we're investing in are the people, because the company will go through pivots and their entire business might change.
When you look at software companies that they say the metrics of you have to hit 1 million ARR after a seed to Series A, do you see a different growth trajectory in healthcare versus software?
Oh, absolutely, yes, for sure. Healthcare, the sales process is not quite the same, right? So it's definitely slower moving, and the benchmarks are different, certainly. And that's the place where it helps to have a healthcare investor on the table, so that they will not try to compare you to the engagement metrics of Facebook and WhatsApp. I think people have pretty realistic sense of what the benchmarks are for healthcare companies. Yeah.
So is the first-time founder completely screwed?
No, absolutely not. I'm sorry. Absolutely not. Yeah. The question is, not at all. I think believe it or not, there are actually advantages to being a first-time founder. We invest in first-time founders all the time. Everyone is a first-time founder at some point, right? So that's an easy one to de-risk, and that's why I was giving that example. But no, absolutely, first-time founders raise money very successfully all the time. I think you just have to borrow credibility from somewhere. Maybe you're a physician who has worked on this problem, or you're a PhD who is working in a lab for 8 or 9 years and just like really knows everything there is to know about ultrasound. So I think you have to gain credibility somewhere. Or have connections, build your network. That helps as well. But I meet plenty of first-time founders. The email example that I showed you was from a first-time founder. And I meet plenty of first-time founders who have just been very thoughtful and methodical in their approach, and just are figuring out ways of de-risking their business, which makes it a lot easier for the investor to buy in.
Question on the digital health side, what you see as the adoption, because it has a lot of solutions out there, also in the chronic disease management space. So what did you see? Is it very slow, or is that the solution? There's more need to be done, or what would be your?
I am not sure I understand the question.
Your views on digital health for chronic disease patient management. What are, based on what you've seen in the space, the solutions in the space, what could be your views?
Yeah, so this is a good question, because I am actually very focused on the chronic disease management space. I think the few things that help there is a solid clinical ground. So even if you haven't done a trial yourself, your research, your product, your technology, your solution is rooted in very solid published research and endorsed by independent third-party organizations, physician organizations, healthcare organizations in general. The other thing that helps is having a very well-designed, intuitive user interface and product that people will want to engage with and come back to. Because in most of the digital health chronic disease management solutions, the key is engagement. If you can drive engagement, that is the cornerstone of success. And it's been traditionally very difficult for people to do that. So I think that's another thing to look for over there. And then the third piece is having a very well-designed program where the patient is not interacting with 10 different people. They have one person who is sort of in charge of taking the patient through their entire journey of the program. I think that relationship building really helps with chronic disease management, because these patients are going to be on your platform for a while, and the care coordination between different providers can become tricky.